Hi everyone, this is Angelina with Angelina Sells Homes at Keller Williams Preferred. Today I'm excited to introduce Beth Jamieson with IServe Lending. Beth is an amazing lender and we're going to be answering some of the most frequently asked questions about the home loan process. Our goal is to help educate anyone thinking about becoming a homeowner and to make the process feel a little less overwhelming. Tell us a little bit about yourself first.
Well, my name is Beth Jamieson. I work with IServe Lending, and I've been doing mortgages for about 28 years now. And yeah, I live in Denver, and I love it here. I have 2 kids. I'm a single mom. Yeah.
So are there any Colorado first-time home buyer assistance programs buyers should know about?
Yeah, so there's lots of first-time home buyer programs, but in Colorado specifically, the best one is CHAFA. CHAFA stands for Colorado Housing Authority, and they are very competitive with the interest rates versus what they do. And the second mortgage is what we call a silent second, so you don't make payments on it. So it sits silently until the buyer goes to sell or refinance down the road, and then it gets paid off. So CHAFA is for first-time home buyers, and they do have, specific requirements, like mainly the income limit. And then there are other down payment assistance programs for people that are not first-time home buyers. It's exclusive to my company. We have a program where it's for people who might have, multiple homes, or they've owned, several homes in the last few years, but they just don't have that ability to save for the down payment, but the income is there. So their monthly income is there. So it's a really nice program because you don't have to be a first-time home buyer and there's no income limit.
What is the realistic minimum down payment buyers need in today's market?
So really, they don't need that much down. If we're doing down payment assistance, CHAFA does require a $1,000 contribution, which can be the appraisal or, the insurance or whatever it may be, and that can be a gift. So that's really nice. And then the other down payment assistance program doesn't require any down payment at all, so not even the $1,000. For people who are under the income limit in what we call the median area income limit, which is, it varies depending on what area we're in. But in Denver Metro, it's around 84,000-ish. If they're under that and they qualify, they can put 3% down on a conventional loan, or FHA, which is very common, it's 3.5% down.
What income limits apply to down payment assistance programs in this area?
Okay, that's a great question, and it's actually way higher than people would think. So it depends on the county and state, the county in Colorado, but Denver Metro is actually, it's kind of a sliding scale, and there's different income limits for different programs. One of their programs goes up to $174,000 a year. And then a different program, so it just depends on which category they fit into, but their first step in first generation, if there's 1 to 2 people in the household, it's $140,000 a year. And then if there's 3 or more people, it's $161,000. And so $161,000 is really, for this program, that's a lot. I mean, that's a lot.
3 people could make together?
Yes. Yeah, so a lot of times people think they make too much because some of the other programs are very low income limit, and you have to, be under that income limit to qualify. But in Colorado, CHAFA allows them to go to a pretty good income limit and still qualify. And then again, the one that we have in-house doesn't have an income limit. So you might have someone who makes, instead of 161, they make 175, and they're over the income limit, but we still would have an option for them for down payment assistance.
With your programs?
Yes.
In-house? USDA loans,
Mhm.
those are 0 down payment, right? And how do you qualify for that?
That's a great question. USDA loans, we really don't see much of those, and there's a reason for it. So there's 2 things that really make you qualify. So one is it has to be in an agricultural zoned area. And so, well, not necessarily agriculture, but it has to be in a rural area. And there's a map that you can go to USDA.com and you can type in the address, or I can do it, and it'll tell you if it's in an eligible area. So that's one thing. The second thing, and this is what's really difficult, the debt to income ratio limits are extremely low. So with other types of loans, and when I said earlier you can go up to 50%, USDA it's 34%. It's very, very low.
Okay.
So these are for the people, and there is also an income limit. So these are for the lower income people who don't have any other debt, really, and that's how they're going to qualify. They just had their mortgage payment. These are for people in rural areas who, you know, they don't necessarily have the money for the down payment, so they don't have to put a down payment down. And the mortgage insurance too, it's very low on those, but there's just such a small group of people that fit into that category.
Are seller concessions still common, and can buyers use them to lower their closing costs?
Yeah, seller concessions are very common still. I see them on almost every contract still. And you know, if you're competing, and you can go into this more when you actually have an offer to present, but you might even offer a little bit more just to get seller concessions than you would if you weren't getting them, just to kind of help offset that if needed. But yes, they're very common.
What are typical closing costs for a buyer in the Denver metro area?
Well, it varies. I mean, there's lots that goes into it. How much are the taxes? How much, is the insurance? Things that we're not going to necessarily know up front. I would say probably between 10 and 12,000 would be average.
And how much money should buyers budget beyond their down payment?
So they're going to want to, there's some moving parts. So they're going to need the money for the appraisal. It's usually about $600 or $700. That gets paid up front. And then the inspection, I mean, you would probably know better than me, but I would say between $300 and $500 for those. Is that
Up to $700. Rate on interview.
and sewer. And then the earnest money. So they have to come up with basically a good faith to hold, the contract that you'll submit with the offer. And really that's it. Just those three things.
Yeah, and the earnest money is usually like 1% to 3% of whatever the purchase price is. So
Yeah, and it goes as a credit towards their down payment. And then if they have enough seller concessions to cover everything, they'll get that back at closing.
oh yeah, that's when people walk away with a closing
Yeah.
check, right? They
Yeah.
got paid to buy the house.
Well, like on Chaffa, if the earnest money is $5,000 and they only need to contribute $1,000, they'll get that other $4,000 back.
How are current interest rates affecting buyer purchasing power right now?
Right now, rates are the lowest they've been in a couple years, so it's a really good time to buy right now. But yeah, I mean, rates don't typically change drastically overnight, but they are lower right now than they have been. So it helps them qualify for a little bit more than they would if the rates were as, higher like a couple months ago.
Right. No, that's awesome. What's the difference between buying now versus waiting for the rates to drop?
Well, that's a very good question. So when I bought my first house, I was 23 and my interest rate was almost 9%. So, rates in the 80s were, in the teens. So relatively speaking, rates right now are still pretty low, but people like to compare what today's interest rates are to like the rates that we saw during COVID in 2020 and 2021, and that's just not likely to happen again. Rates right now are where they were, for years leading up to COVID. So I don't think that people should really focus on the interest rate now versus, looking at what their monthly payment is versus what they're paying for rent and those kinds of things. And of course, if the rates drop, we can always refinance down the road. So I think now's the time to buy.
Yeah.
When you wait, you lose equity. You lose that opportunity of getting your foot in the door to home ownership.
Exactly. Tell me about what an ARM is.
Well, an ARM is an adjustable rate mortgage. And honestly, the market kind of prices itself the way it wants people to, it guides itself. So like ARMs right now are not really a thing. They haven't been in years because ARMs, the interest rate for a 30-year fixed is a better interest rate than an ARM. So there's really no reason to look at them right now. In the past, you could look at an ARM versus a fixed rate for if I'm only planning to live there for 3 years or whatever, but the market really isn't that way right now. So the first part of an ARM is the amount of time that it's fixed. And then after the ARM is up, depending on what index it's based off of, there's it's based off of prime. So it could go up or down after the fixed amount of time is up. Builders are a little different than the regular market because they typically buy interest rates in bulk for the clients that they expect to sell. So what I said about ARMs doesn't necessarily pertain to if you were comparing it to a builder.
What is the biggest mistake buyers make when shopping for mortgage rates?
The thing about it, like when you're shopping around for a mortgage rate, you're looking at more than just the rate, right? Because some lender might have a huge origination fee, but a lower interest rate, or vice versa. So you're really shopping for the rate and closing costs to kind of compare apples to apples.
And do you suggest that people contact 3 different lenders and try to figure out, like, what questions, I guess, would they ask the lender?
To get a copy of the loan estimate, because a loan estimate is something tangible in writing that they can take and, if they were shopping with 3 different lenders, they can look at all 3 and see which is going to be the best fit for them.
So the loan estimate is what they should get, and then they can compare it?
Yeah, so some lenders might not actually give a loan estimate. They might give just like a list of fees, which is not the same as an actual loan estimate. So it's really nothing binding until you get that.
Okay. How long does it take to get fully underwritten and like offer ready before submitting an offer?
So it really depends on if they're fully underwritten by an actual person or by the automated underwriting system. And it really has to do with the layer of risk in the file. So if I get a file that, there's a lot of marks on their credit and there's a lot of collections and different things that, I don't get an automated underwriting approval, which is basically running it through the system and it shoots out an approval, That's different because that can be done, in a day. Once I have all the documentation back, it's a very quick and easy thing for me to do. But if I have to send it in for what we call manual underwrite, I don't like to give anyone a pre-approval letter until we have a physical underwriter review it, because at that point it's their discretion. They're looking at the file, they're looking at the layers of risk, and they're making a decision on whether they're going to move forward with the file, because someone might have like really poor credit history, but they might have really good reserves. And that's what we like. We like to know that if someone were to default on their mortgage, that they have reserves that they can pay if they lose their job or something comes up. So an underwriter is more likely to approve a file like that than was, someone that has poor credit history. But
no money. No
exactly.
Reserves.
No reserves, no poor credit history, very high debt to income ratio. So we look at those all as a layer of risk, and whether we're going to approve it is going to be that underwriter's decision at that point. And so those I like to submit ahead of time, and those, I would say 2 weeks.
Okay, 2 weeks probably.
Yeah.
What are 3 things buyers should not do financially once they're under contract?
Oh, 3 things. Well, there's a lot of things they shouldn't do, but 3 things. So they should not have their credit pulled, because we don't want to risk having an inquiry on their credit during the process if it were to affect their score. Someone with a really high credit and they're in like the top tier, or above I would say a 740 or 760, doesn't really have anything to worry about. But pricing for conventional loans is tier. It is a tier, so it's score driven. So if they have a 720, 740, 760 and on up, that does affect their interest rate. So we don't want to have anything happen to the score. Definitely don't go out and buy anything. Don't go and open a new credit card for furniture or go buy a new car or do anything like that during the process, because that'll affect their debt to income ratio. So we don't want anything like that. And we also don't want them to close any accounts. Closing accounts or paying off collections or things like that could negatively affect their score, as well as opening accounts.
So even if they pay off a credit card, they shouldn't pay off something.
Because if a credit card is paid off in full, it takes that score ratio to 0. So 0 times 0 is nothing. So it removes that trade line from their credit scoring model. So if they have a credit card and they wanted to pay it off, I wouldn't suggest doing it until closing. But if they really do it ahead of time and they really want to do that, then I would say leave a $10 balance. balance, pay it off and leave it a small balance. So it still gives them that ratio on that card of their balance to their limit. There are credit counseling places available. I've been doing this for long enough that I can pretty much look at it and kind of go through and see why their score might be the way it is. And we have a program that's a rapid rescore where you can do it a couple different ways. You can do it with a score, like if they have, for instance, a 590 and we want to get to a 600, we can plug in what we need to do to get to that score, and it'll tell us how much money that it'll take to get to that point. Or if we have a certain amount of money, like let's say they only have 500, it'll tell us how high they can get the score with that amount of money.
To where to put it and what,
how to allocate those funds. Yeah. So there's different ways that the rapid rescore works, but absolutely we can help.
Okay. What credit score do you buyers in Denver usually need to get into their first home?
Great question. So with CHAFA, they do require a 620. With the other down payment assistance that I mentioned that we have in-house, they only require a 600. So if someone doesn't qualify for CHAFA, I still have the other one to fall back on. And we have other down payment assistance programs as well, but in Colorado, those are going to be the best ones. Someone that has a 580 to a 620 can still put the minimum down on an FHA loan of 3.5%, and we still have options for that. If someone has under a 580, they can still qualify for a mortgage, and a lot of people don't realize that. So if someone has, let's say, a 540 credit score, but they're selling a house and they're going to have $100,000 to put down on the new property, that will likely still get approved. So there's no credit score minimum per se. It's just, we look at the whole file.
So this is a good one. How much house can someone making $100,000 afford here in Denver?
So, it's relative, right? So someone making $100,000, that's a great income, but they might have so much debt that they might have, a $700 car payment and all their credit cards are maxed out. And so it's really relative to what the situation for that person looks like. If they don't have any debt, $100,000 a year, we can't go realistically above 50% of what their income is for their new mortgage payment. So they'd easily be able to afford between, $400,000 and $600,000, depending on
the debt, right? So as long as they didn't have a lot of debt, then they could get something like that.
Right, but it depends on the situation and really how much debt they have. Yeah.
What is one myth about mortgages you wish buyers understood?
I would say that you have to have a large down payment and that they're difficult to get. A lot of people that come to me are very concerned that they're not going to qualify, and you really just don't know unless you try, And I find, as you know, one of the biggest challenges of getting a mortgage or a pre-approval is just getting people to apply and send me their paperwork. The paperwork part is probably the most challenging part of any file, because you do have to be prepared. If you want a loan, we have to be able to see in writing your W-2s and your tax returns and your pay stubs and your bank statements and all of these things. So I think it's just, people think that it's incredibly difficult to get a mortgage, and it's really not. If you have a job and you have a credit score and you have income, you can get a loan.
Right.
And it's truly not that much. We only go off of the most recent month's worth of pay stubs, 2 most recent months of bank statements, so we're going back 60 days, and then the past 2 years W-2s and tax returns, just so we can see, we don't necessarily need the tax returns, but I asked for them to know if I can eliminate them or not, because we don't want something to show up later and they had a Schedule C or a Schedule E and I haven't reviewed that and I didn't know it was there without seeing them. But if I get their tax returns and they're just straight up W-2s, we don't even need them.
Okay.
So, and then we get the 2 most, I mentioned the 2 most recent months of bank statements and then their driver's license, and that's it. It's not like this crazy amount of documentation that we ask for. And some loans, conventional, we don't even need 2 years. We sometimes can just use the 1 year, their most recent year.
Do they have to have a job for 2 years at the same place?
No, not at the same place. We want it to be ideally in the same field, but it doesn't necessarily have to be in the same field of work. Like if someone was an office assistant at like an eye doctor or something like that, and then they moved and got an office assistant job at a car dealership, that's the same line of work, you know? So really, and if they're in a totally different line of work, but they're getting a salary or a guaranteed 40 hours of work, that's okay too. We can use that. But they definitely don't have to be at the same job for 2 years.
And so the last question, is now a good time to buy?
Oh yes, it's always a good time to buy. 100% absolutely.
All right. Cool. Thank you. If you have any questions about buying a home, financing, or anything related to the process, feel free to send me a direct message. We'd love to include your questions and help get them answered also. I'm always here to be a resource to help guide and educate you on the path to home ownership.